The Intelligent Investor, written by Benjamin Graham and first published in 1949, is a cornerstone in the world of investing. Graham, a renowned economist and investor, aimed to provide a clear, accessible framework for individual investors. At the time, most investment advice was reserved for the wealthy elite, but Graham wanted to democratize financial knowledge and empower the average person to make rational, informed decisions in the unpredictable world of finance. The book is grounded in two key principles: value investing and the Mr. Market analogy. Value investing emphasizes buying undervalued stocks with a margin of safety, focusing on long-term returns rather than short-term gains. The Mr. Market analogy highlights the market's volatility, illustrating how emotional swings can cause irrational price fluctuations. Graham encouraged investors to take advantage of these swings, buying when prices are low and selling when prices are high. In 1971 to 1972, Graham updated the book, incorporating lessons from his years of experience and refining his theories for a changing market. The revised edition was first published in 1973, ensuring that the Intelligent Investor remained relevant as market conditions evolved. This version included new insights and strategies, yet the core principles remained intact, offering timeless advice for investors. The book profoundly impacted some of the world's greatest investors, including Warren Buffett, who has often cited Graham as his greatest influence. Despite numerous updates, the Intelligent Investor continues to guide investors in navigating the complexities of modern financial markets. Benjamin Graham covers this book with 20 chapters. 1. Investment versus speculation, results to be expected by the Intelligent Investor. 2. The Investor and Inflation. 3. A century of stock market history, the level of stock prices in early 1972. 4. General portfolio policy, the defensive investor. 5. The defensive investor and common stock. 6. Portfolio policy for the enterprising investor, the positive side. 7. The enterprising investor and common stocks. 8. The investor and market fluctuations. 9. Investment results, the investor and his advisors. 10. Security analysis for the lay investor, general approach. 11. Things to consider about per share earnings. 12. The dividend policy of common stocks. 13. A comparison of the various investment alternatives. 14. Stock selection for the defensive investor. 15. Stock selection for the enterprising investor. 16. Convertible issues and warrants. 17. For extremely instructive case histories and more to learn from them. 18. A case history of speculation, the fluctuations in common stocks and their meaning. 19. The investor and the economy. 20. Margin of safety, as the central concept of investment. These chapters collectively guide you through the principles of value investing, from understanding market fluctuations to selecting stocks that fit specific investment strategies. These strategies. Keep learning to understand each chapter deeply so that you can apply its lessons to your life. Chapter 1, Investment versus Speculation, Results to be Expected by the Intelligent Investor. In the first chapter of The Intelligent Investor, Benjamin Graham distinguishes between investment and speculation, a fundamental concept in his approach to the financial markets. He argues that many people blur the lines between these two, but understanding the difference is crucial for anyone wanting to succeed in the market. Investment versus speculation. Investment. Graham defines investment as the process of purchasing securities, stocks, bonds, etc., based on a thorough analysis of their intrinsic value. Investors focus on the long-term value of their holdings, considering factors like earnings, dividends, and the company's financial health. The primary goal is safety of principal and a reasonable return over time. Speculation. Speculation, on the other hand, involves buying securities with the expectation that their price will rise in the short term due to market trends or other unpredictable factors. Speculators are often driven by market psychology and price movements, rather than fundamental analysis. Graham points out that speculation is far riskier, as it depends on the fluctuating sentiments of the market rather than sound financial data. The results to be expected, investment results. Graham suggests that investors should expect their returns to be moderate, reflecting the steady growth of the companies they invest in. It is a long-term approach that avoids high risk and focuses on a steady, predictable return over time. Investors should expect reasonable profits based on the real value of their investments, which will compound slowly over time. Speculation results. For speculators, Graham warns that the results are far less predictable and far more volatile. Speculators may experience quick gains, but they are just as likely to incur significant losses. This approach relies on the market's short-term moods and external events that can quickly change stock prices. Because of the unpredictable nature of speculation, Graham advises against relying on this approach for long-term wealth creation. The Intelligent Investor's approach, the intelligent investor, according to Graham, should always focus on the long-term value of investments and avoid the temptation of short-term speculation. They should seek investments that are undervalued in the market and hold them for the long haul, even in the face of market fluctuations. Graham emphasizes the importance of having a clear distinction between investment and speculation in the mind of the investor, as this will shape how they approach the market, the level of risk they are willing to accept, and the results they can realistically expect from their investments. He stresses that while speculation might seem exciting, the real profits come from disciplined, value-focused investing over time. This chapter sets the tone for the entire book, outlining Graham's philosophy of risk-averse, long-term investing based on fundamental analysis. By laying out the difference between speculation and investment, Graham helps the reader understand that sustainable wealth is built on thoughtful, deliberate decisions, not on hasty, speculative moves. Chapter 2, The Investor and Inflation. In Chapter 2 of The Intelligent Investor, Benjamin Graham discusses the relationship between inflation and investment, a critical topic for any investor concerned with preserving and growing their wealth over time. The chapter focuses on how inflation erodes purchasing power and the impact it has on investments, urging investors to be mindful of inflation's effects while making their investment choices. Understanding inflation, Graham begins by explaining inflation as the general increase in prices and the corresponding decrease in the value of money. Inflation can result from several factors, such as increased demand for goods and services, higher production costs, or expansionary monetary policies by governments. Regardless of the cause, inflation impacts the economy and the financial markets by eroding the value of money over time. For example, if inflation is high, the purchasing power of a dollar decreases, meaning consumers can buy fewer goods and services for the same amount of money. This erosion of purchasing power is a significant threat to investors because the real value of their investments is diminished. Inflation's impact on investments. Graham points out that inflation doesn't affect all investments equally, and investors must be aware of how different asset classes respond to inflationary pressures. Bonds and fixed income investments. Bonds, especially long-term bonds, are most vulnerable to inflation. As inflation rises, the fixed interest payments from bonds lose their purchasing power. For example, if an investor holds a bond that pays a fixed interest rate, the value of those payments becomes smaller over time as inflation increases. Additionally, inflation can lead to higher interest rates, which can negatively impact the price of existing bonds. Stocks, equities, stocks, on the other hand, are somewhat better positioned during inflationary periods. Companies may be able to raise prices on their products and services to keep up with inflation, thereby maintaining or even increasing their profits. However, this depends on the company's ability to pass on inflation costs to consumers without damaging demand. Graham notes that while stocks tend to fare better than bonds during inflationary times, they are still subject to the broader economic environment and inflationary pressures. Real assets, real estate, commodities. Real assets, like real estate and commodities, e.g., gold, oil, often perform better in inflationary environments. These assets typically appreciate in value as the prices of goods and services increase. For example, real estate properties often rise in value as construction and land costs increase due to inflation, making them a potential hedge against inflation. Inflation protection strategies for investors. Graham emphasizes the need for investors to adopt strategies that protect their portfolios from the negative effects of inflation. He suggests several ways to do this. Diversification. One of the best ways to protect against inflation is to diversify across different asset classes. By holding a mix of stocks, bonds, and real assets, investors can reduce their exposure to inflation risks. For example, while bonds may struggle during inflationary periods, stocks and real assets may provide better returns. Investing in companies with pricing power. Graham recommends investing in companies with strong financial health and a demonstrated ability to raise prices without damaging demand. These companies are better equipped to withstand inflationary pressures and continue to generate profits. Focus on value. As in other areas of investing, Graham advises focusing on undervalued assets, as they can provide more substantial returns over time, even in inflationary environments. Companies with solid fundamentals, low price-to-earnings ratios, and strong growth potential are better positioned to handle inflation's impact. Real assets. For those particularly concerned with inflation, investing in real estate, commodities, or inflation-protected bonds can serve as a hedge. These types of investments tend to hold or increase in value as inflation rises, protecting investors' wealth. In this chapter, Graham urges investors to recognize the importance of inflation in their long-term investment strategy. While inflation is an inevitable part of economic cycles, the intelligent investor should be proactive in managing the risks it poses to their portfolio. By diversifying investments and focusing on assets that can either benefit from or withstand inflation, investors can better preserve their wealth and continue to generate returns over time. This chapter teaches that, while inflation is a persistent and unavoidable economic force, investors can protect themselves by maintaining a diversified and thoughtful approach to their investment choices. Understanding inflation's effects and taking steps to mitigate its impact is key to successful, long-term investing. Chapter 3, A Century of Stock Market History, The Level of Stock Prices in Early 1972. In Chapter 3 of The Intelligent Investor, Benjamin Graham takes a historical approach to understand stock market performance, focusing on a century of stock market trends and the level of stock prices in the early 1970s. This chapter provides essential context for investors, encouraging them to view stock market fluctuations with a long-term perspective and to avoid overreacting to short-term market events. A historical overview of the stock market, Graham begins by taking a step back and reflecting on the stock market's history, examining how prices have fluctuated over time. He emphasizes that the stock market is highly cyclical, marked by periods of growth followed by corrections and even crashes. Understanding the broader historical context allows investors to see past the immediate noise and focus on the long-term trends that define the market's evolution. He explains that over the course of a century, the stock market has experienced dramatic ups and downs, but it has consistently delivered positive returns over long periods. For instance, despite the Great Depression, multiple recessions, and various financial crises, the overall trend for the stock market has been one of growth, albeit with significant volatility in the short term. The stock market in 1972, Context and Concerns. Graham then focuses specifically on the stock market in early 1972. At that time, the market had experienced a significant bull run following the recovery from the 1960s economic slowdown and the market's subsequent rise. However, Graham warns that investors should not become overly optimistic in such periods of rapid growth. He compares the market's condition in 1972 to earlier periods in history when stock prices became inflated due to speculative enthusiasm. At the time, stock prices had risen significantly, and many were buying into the market based on the belief that it would continue its upward trajectory indefinitely. Graham cautions investors against this bullish mindset and highlights the importance of maintaining a balanced, prudent approach during market booms. The relationship between stock prices and earnings. One of the key lessons Graham shares in this chapter is the relationship between stock prices and earnings, also known as the price-to-earnings (P/E) ratio. The P/E ratio is a measure of how much investors are willing to pay for a company's earnings, and it provides insight into whether stock prices are inflated. Graham discusses the danger of paying excessively high prices for stocks in times of market optimism. He points out that in 1972, stock prices were rising at a pace far exceeding earnings growth, leading to a disconnect between market prices and the underlying value of companies. This disconnect, in Graham's view, is a classic warning sign that the market may be overheating and that a correction could be imminent. He reminds investors that while the stock market can generate impressive returns over the long run, it is also highly susceptible to market cycles. In periods of excessive optimism, stocks may become overvalued, leading to poor returns or even significant losses when the market corrects itself. The concept of market timing and valuation. Graham also touches on the importance of valuation in this chapter, specifically the concept of market timing. He argues that trying to time the market, buying during periods of growth and selling during downturns, can be disastrous for investors. Instead, he advocates for a focus on long-term value investing, emphasizing the need to purchase stocks at reasonable prices based on their intrinsic value. He also discusses the role of speculation in inflating stock prices. During times of speculative fever, like the early 1970s, investors may become overly focused on price movements rather than the fundamentals that drive value. Graham warns that this kind of behavior often leads to short-term gains but long-term losses as the market corrects itself. The intelligent investor's approach. From Graham's perspective, the intelligent investor should avoid following the crowd during times of market speculation. Instead, they should maintain a long-term focus, buying stocks that are undervalued relative to their intrinsic worth. In doing so, they can avoid the pitfalls of speculative bubbles that inevitably burst. Graham's analysis in this chapter offers a cautionary tale for investors, showing that while stock prices can rise dramatically, it's essential to maintain a grounded, value-oriented perspective. By focusing on companies' earnings and their ability to grow over time, investors can protect themselves from the risks of overpaying for stocks during times of market exuberance. Summary of key points from the chapter. Long-term market trends. While the stock market has periods of rapid growth, it is cyclical, and short-term fluctuations are common. Valuation matters. stocks should be bought based on their intrinsic value, not speculation or market trends. The P/E ratio is an important indicator of whether stocks are overvalued. Caution during bull markets. During periods of excessive optimism, stock prices can become disconnected from earnings, creating the risk of a market correction. Avoid speculation. Rather than trying to time the market, investors should focus on long-term value investing. In summary, Chapter 3 of The Intelligent Investor urges investors to keep a historical perspective and avoid getting swept up in short-term market trends. By understanding the cyclical nature of the stock market and focusing on value, investors can navigate periods of market volatility and ultimately secure long-term financial success. Chapter 4, General Portfolio Policy, The Defensive Investor. In Chapter 4 of The Intelligent Investor, Benjamin Graham discusses the portfolio policy for the defensive investor. This chapter focuses on how conservative investors, those who prioritize the safety of their principal and prefer a hands-off approach to investing, should structure their portfolios to achieve steady returns with minimal risk. Who is the defensive investor? The defensive investor is someone who seeks to minimize risk and does not have the time, expertise, or desire to actively manage their investments. Unlike the enterprising investor, who may seek out undervalued opportunities and actively manage their portfolio, the defensive investor's primary goal is capital preservation, with the secondary aim of generating a reasonable return. Graham emphasizes that the defensive investor must prioritize security and avoid speculative investments that carry unnecessary risk. Defining the defensive investor's portfolio, Graham suggests a simple and structured approach to creating a portfolio for the defensive investor. The key to success is diversification, which reduces risk by spreading investments across different asset classes, sectors, and types of securities. The defensive investor should aim to allocate their portfolio in a balanced way between bonds and stocks, with the exact ratio depending on the investor's risk tolerance and market conditions. 1. The 50-50 split, a balanced approach. In general, Graham recommends an allocation of 50% stocks and 50% bonds for the defensive investor. This mix offers a reasonable balance between the growth potential of equities and the safety of bonds. The rationale behind this approach is that stocks provide higher returns over time, but they come with greater risk and volatility, while bonds offer stability but lower returns. Stocks. For the defensive investor, the stocks should primarily be large, well-established companies with a proven track record of performance. These are often referred to as blue-chip stocks. The defensive investor should focus on diversified, index-based investments rather than picking individual stocks. This strategy helps minimize risk and provides exposure to the overall growth of the market. Bonds, on the other hand, provide a steady income stream and reduce overall portfolio risk. Graham advises that the defensive investor should invest in high-grade, investment-grade bonds, avoiding high-risk or speculative bonds that may offer higher returns but at a much greater risk to principal. 2. Rebalancing the portfolio. While the 50-50 allocation is a general guideline, Graham stresses that the defensive investor should also rebalance their portfolio periodically. This means adjusting the ratio of stocks to bonds to maintain the intended balance. If stock prices rise significantly, the portfolio may become more stock-heavy, and the defensive investor should sell some of those stocks and purchase more bonds to return to the balanced allocation. Rebalancing ensures that the investor stays aligned with their risk tolerance and does not overexpose themselves to either asset class. The importance of diversification. Diversification is one of Graham's most important principles. In the context of the defensive investor, it involves spreading investments across different types of bonds and stocks to reduce risk. The defensive investor should avoid putting all their money into a single stock or bond, as this would increase the risk of significant losses if that specific asset underperforms. Stock diversification. For stocks, Graham recommends broad market indices or funds that represent a wide range of industries. This way, the investor is not dependent on the performance of any one sector. Investing in large-cap, blue-chip stocks, or low-cost index funds ensures broad market exposure without concentrating risk in individual companies. Bond diversification. Similarly, with bonds, the defensive investor should invest in bonds of varying maturities, credit ratings, and issuers. A well-diversified bond portfolio can help smooth out returns and protect against interest rate fluctuations or bond defaults. Choosing stocks. For the defensive investor. When it comes to selecting individual stocks, Graham advises the defensive investor to avoid speculative growth stocks. Instead, the focus should be on stocks of stable, large companies that have demonstrated a history of consistent earnings, dividend payments, and solid financial health. The goal is to choose companies that are likely to weather market downturns without significant losses. Graham suggests that defensive investors should consider the following criteria when selecting stocks: sound financial history, look for companies with consistent earnings and a strong balance sheet. Attractive valuation, avoid stocks that are overvalued. Graham suggests investing in stocks with a reasonable price relative to earnings. Dividend payments, companies that regularly pay dividends can provide a steady income stream, which is important for a defensive investor. The role of bonds in the defensive investor's portfolio. Bonds play a crucial role in the defensive investor's portfolio, providing stability and income. Graham emphasizes the importance of choosing high-quality bonds, e.g., U.S. government bonds or investment-grade corporate bonds, to ensure safety of principal and steady returns. Bond maturity. Graham also highlights the importance of bond maturity. Long-term bonds may offer higher returns, but they are more sensitive to interest rate changes, making them riskier in rising rate environments. Short-term bonds are safer but offer lower returns. Graham recommends a balanced mix of short and long-term bonds to strike a reasonable balance between risk and return. Income stability. Bonds offer predictable income, and Graham suggests that the defensive investor should rely on them for consistent cash flow, which can be reinvested into the portfolio or used to meet living expenses. The role of cash and other liquid assets. In addition to stocks and bonds, Graham advises the defensive investor to hold some cash or cash equivalents in their portfolio, such as money market funds or short-term government securities. This helps the investor maintain liquidity and provides a buffer in case of emergencies or market downturns. Graham suggests that cash should not constitute a large portion of the defensive investor's portfolio, but it can act as a safeguard against unforeseen market conditions, allowing the investor to take advantage of opportunities without having to sell other assets at an inopportune time. What you can learn from the intelligent investor. For the defensive investor, the goal is not to chase high returns but to maintain a stable, diversified portfolio that protects against loss while generating reasonable returns. The defensive investor should focus on minimizing risk and avoid speculation. By maintaining a 50-50 split between stocks and bonds, diversifying across asset classes, and focusing on high-quality, stable investments, the defensive investor can achieve steady growth over the long term without unnecessary risk. Graham's advice in this chapter is to build a portfolio that is simple, low-risk, and well-diversified. The intelligent investor who follows these principles will be able to weather market volatility and achieve solid, long-term returns without the stress of frequent decision-making or speculation. Chapter 5. The Defensive Investor and Common Stocks. In Chapter 5 of The Intelligent Investor, Benjamin Graham expands on the role of common stocks within the defensive investor's portfolio. While the previous chapter emphasized the importance of a balanced approach between stocks and bonds, this chapter delves deeper into how the defensive investor should approach the stock portion of their portfolio to maximize safety while still seeking reasonable returns. The role of common stocks for the defensive investor. Graham acknowledges that common stocks are generally considered more volatile and risky compared to bonds. However, they also offer greater potential for long-term growth. He argues that the defensive investor can still benefit from stocks by focusing on companies that are financially sound and trading at reasonable prices. The defensive investor's primary goal should be to select stocks that provide stability, dividends, and the potential for steady growth, rather than speculating on high-risk, high-reward stocks. The risks and rewards of common stocks. Graham begins by acknowledging that stocks are more volatile than bonds and can experience significant fluctuations in the short term. However, he also points out that over the long term, stocks tend to outperform bonds in terms of total returns, primarily through capital appreciation and dividend payments. Capital appreciation. Stocks have the potential to grow in value over time, leading to significant capital gains. This is especially important for the defensive investor, as stocks can offset the lower returns typically offered by bonds, which are more stable but offer less growth potential. Dividends. In addition to capital appreciation, stocks can provide a steady stream of income through dividends. Graham highlights the importance of dividend-paying stocks for the defensive investor. Dividends not only provide income but can also act as a sign of a company's financial health and stability. Despite the rewards, Graham warns that common stocks come with significant risks, especially if the investor is focused on short-term speculation or does not thoroughly analyze the stock's fundamentals. The key is to focus on long-term value and avoid speculative behavior. How to select common stocks for the defensive investor. Graham suggests a conservative and disciplined approach to selecting stocks for the defensive investor's portfolio. The primary goal should be to choose companies that have a proven track record of stability and financial soundness, and that are likely to continue performing well in the future. Some of the criteria that Graham recommends for selecting stocks are: 1. Size and stability of the company. Large, established companies, the defensive investor should focus on large-cap companies with a long history of stable earnings and dividends. These companies tend to be less volatile and more resilient during market downturns. Financial strength. Graham advises investors to look for companies with strong balance sheets, low levels of debt, and a consistent history of profitability. A company's financial stability helps protect investors during tough economic times. 2. Earning stability and growth. Consistent earnings. One of the most important criteria for selecting stocks is earnings stability. Graham suggests that the defensive investor should choose companies that have demonstrated consistent earnings growth over a period of at least 10 years. Companies that have a history of reliable earnings are less likely to experience sudden declines. Reasonable growth prospects. While the defensive investor doesn't need to focus on high-growth stocks, companies that can generate steady growth over time are preferable. Companies with reasonable growth prospects are more likely to provide a solid return on investment without excessive risk. 3. Dividend payments. Regular and growing dividends. Graham stresses the importance of dividends for the defensive investor. Dividend-paying companies are typically well-established and financially stable. The defensive investor should prioritize stocks that offer steady or growing dividends over speculative growth stocks that do not provide any dividend income. Dividend yield. Graham recommends looking for companies with a moderate dividend yield, which provides a good balance between income generation and growth potential. Extremely high dividend yields may indicate potential problems, such as declining earnings or financial instability. 4th, price-to-earnings, P/E, ratio and valuation. Reasonable valuation. Graham emphasizes that the defensive investor should never overpay for stocks, even if they meet all other criteria. A company may appear stable, but if it is trading at an inflated price relative to its earnings, a high P/E ratio, the stock may not offer an adequate margin of safety. Margin of safety. Just as with bonds, the defensive investor should look for stocks that are trading at a reasonable price relative to their intrinsic value. A low P/E ratio compared to the industry average or the stock's historical valuation is often a sign that the stock is undervalued and offers a better margin of safety. The defensive investor's approach to stock diversification. Graham reinforces the importance of diversification in the defensive investor's stock portfolio. Rather than investing heavily in a single stock, the defensive investor should spread their investments across a range of large, financially sound companies to reduce the risk of loss from any single company's poor performance. Diversification through index funds. For the defensive investor who lacks the time or expertise to select individual stocks, Graham suggests investing in low-cost index funds that represent a broad market index, such as the S&P 500. These funds offer instant diversification and are generally composed of well-established companies that meet Graham's criteria for stability and growth. Geographic and sector diversification. While the chapter mainly focuses on domestic investments, Graham also suggests that the defensive investor may consider some level of geographic and sector diversification to protect against sector-specific or regional economic downturns. The defensive investor's strategy, long-term focus. In this chapter, Graham urges the defensive investor to take a long-term approach to stock investing. Unlike short-term traders or speculators, the defensive investor should resist the urge to constantly buy and sell based on market fluctuations. Instead, the goal is to purchase solid companies at a reasonable price and hold on to them for the long term, benefiting from their steady growth, dividends, and overall market appreciation. Valuable insights every investor should keep in mind. For the defensive investor, common stocks are an important component of a well-balanced portfolio, but they must be approached with caution. Graham's approach involves focusing on large, stable companies with a history of reliable earnings and dividends. By following strict criteria for stock selection and maintaining a diversified portfolio, the defensive investor can enjoy the benefits of stock market growth while minimizing unnecessary risk. Ultimately, the defensive investor should avoid speculation and focus on long-term, value-based investing in well-established companies. By doing so, they can achieve steady returns, preserve their capital, and enjoy the benefits of a balanced investment strategy. Chapter 6, Portfolio Policy for the Enterprising Investor, Negative Approach. In Chapter 6 of The Intelligent Investor, Benjamin Graham outlines the portfolio policy for the enterprising investor, specifically focusing on the negative approach. While the defensive investor aims for safety and stability with minimal risk and effort, the enterprising investor is more willing to take on additional risk and effort in order to achieve superior returns. The negative approach, as discussed by Graham, focuses on avoiding common mistakes and minimizing risks, rather than seeking out speculative opportunities. Who is the enterprising investor? The enterprising investor is someone who is willing to put in more effort, time, and resources into managing their portfolio compared to the defensive investor. They are typically more involved in the market and may seek to outperform the average market returns through active management and careful selection of individual investments. However, the enterprising investor should still avoid unnecessary risks and focus on sound, rational strategies that enhance returns without relying on luck or speculation. The enterprising investor's goal is to achieve better than average returns over the long term, but this requires a higher level of skill, knowledge, and effort. Graham stresses that while the enterprising investor is willing to take on more risk, they must do so cautiously, applying a negative approach to avoid dangerous or overly speculative investments. The negative approach, minimizing risk and avoiding speculation. The negative approach, as Graham describes it, focuses on avoiding the most obvious mistakes and pitfalls that lead to losses or underperformance. This approach doesn't aim to find the perfect investment, but rather to sidestep the worst mistakes that could harm the investor's portfolio. For the enterprising investor, this means focusing on risk management, protecting principal, and making rational decisions based on value rather than speculative trends. Graham emphasizes that avoiding large losses is more important than chasing high returns. By focusing on avoiding major pitfalls and reducing exposure to risky or overvalued assets, the enterprising investor can protect their capital while still seeking opportunities for growth. Here are some key principles of the negative approach. 1. Avoiding speculative investments. Graham warns against investing in speculative, high-risk assets that promise quick returns but are often based on little more than market hype or investor sentiment. These speculative investments, such as stocks in companies with little to no earnings, commodities, or highly volatile assets, may offer the potential for large gains, but they also carry the risk of catastrophic losses. For the enterprising investor, the negative approach involves steering clear of such speculative investments and focusing on assets with solid fundamentals and a margin of safety. Speculative stocks. These are stocks in companies that may not be profitable or have uncertain future prospects. The negative approach calls for avoiding these types of investments, as they are more likely to lead to losses rather than gains. Penny stocks. Graham also advises against investing in low-priced stocks, often referred to as penny stocks, which are frequently subject to speculation and price manipulation. 2. Avoiding overpaying for stocks. Another key part of the negative approach is to avoid overpaying for stocks. Even if a company seems promising, buying its stock at an inflated price can severely limit the investor's potential returns. Overpaying for stocks increases the risk that the market will correct the price, leading to significant losses. The enterprising investor should focus on finding stocks that are undervalued relative to their intrinsic worth, even if they are less exciting or popular in the short term. Price-to-earnings (P/E) ratio. The P/E ratio is an essential tool in evaluating whether a stock is overpriced. Graham suggests that the enterprising investor avoid stocks with high P/E ratios, as these may indicate overvaluation. Margin of safety. One of Graham's core principles is to buy with a margin of safety, investing in stocks that are priced below their intrinsic value. This provides a cushion against market downturns and helps avoid significant losses. 3. Avoiding overly complex or risky investment strategies. Graham stresses that the enterprising investor should not get caught up in overly complex or speculative investment strategies. While there are opportunities for higher returns in areas like options trading, futures contracts, and other derivative markets, these strategies often involve higher risks and require significant expertise. The negative approach advises against these strategies for most investors, as they can lead to losses that are difficult to recover from. Options and futures. These are highly speculative financial instruments that can lead to large losses, particularly when investors don't fully understand the risks involved. Graham recommends that the enterprising investor avoid these types of investments unless they have substantial experience and knowledge. 4. Avoiding unnecessary diversification. While diversification is an important principle for the defensive investor, Graham suggests that the enterprising investor should avoid unnecessary diversification. Over-diversification can dilute potential returns, as it forces the investor to spread their capital across too many investments, many of which may not meet their criteria for strong returns. Instead, Graham suggests that the enterprising investor should focus on a select few investments that offer the best potential for growth, based on careful analysis and fundamental research. This could involve making more concentrated bets on companies that meet the investor's value criteria. However, Graham also cautions that concentration increases risk, so the enterprising investor must carefully assess the risk-reward balance when choosing how much to allocate to individual investments. 5. Avoiding the herd mentality. Graham warns against following the herd mentality, which occurs when investors blindly follow the crowd without considering the intrinsic value of an investment. This often leads to investing in popular stocks or sectors that are overvalued due to market enthusiasm. The enterprising investor should not succumb to market fads or hype but should instead focus on independent research and analysis. Market trends. Rather than chasing the latest trends or following the crowd, the enterprising investor should take a more measured approach, analyzing opportunities based on their intrinsic value and long-term potential. 6. Avoiding emotional decision-making. Finally, Graham advises that the enterprising investor should avoid emotional decision-making. Emotional reactions to market fluctuations, such as fear during a downturn or greed during a rally, can lead to impulsive decisions that harm long-term results. The negative approach calls for rationality, patience, and discipline when managing an investment portfolio. Patience. Successful investing often requires a long-term perspective. The enterprising investor should resist the urge to make quick decisions based on short-term market movements. Key lessons and strategies that every investor can benefit from. In this chapter, Benjamin Graham highlights the importance of taking a negative approach when pursuing the enterprising investor strategy. By avoiding speculative investments, overpaying for stocks, and overly complex or risky strategies, the enterprising investor can minimize significant risks while still aiming for superior returns. The focus should always be on value, safety, and rational decision-making, rather than on following market trends or attempting to time the market. Ultimately, the negative approach is about avoiding the mistakes that could derail an investment strategy and ensuring that the enterprising investor's decisions are based on sound principles and analysis. By focusing on risk management and prudent choices, the enterprising investor can navigate the market successfully and achieve long-term growth. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. In Chapter 7 of The Intelligent Investor, Benjamin Graham explores the positive side of portfolio policy for the enterprising investor. While the previous chapter focused on the negative approach, avoiding speculative risks and mistakes, the positive side involves actively seeking opportunities for better-than-average returns. The enterprising investor, Graham asserts, must not only avoid pitfalls but also pursue investments that offer solid potential for growth and profitability. Key strategies for the enterprising investor. Graham outlines several strategies for the enterprising investor to achieve superior returns while managing risk effectively. 1. Finding undervalued stocks. The enterprising investor should focus on identifying undervalued stocks, companies that are trading below their intrinsic value. These stocks have the potential for significant price appreciation once the market corrects their valuation. The key is thorough analysis to uncover opportunities that others may overlook. 2. Special situations. Graham also highlights the concept of special situations, unique opportunities that may arise from corporate actions like mergers, acquisitions, spin-offs, or restructurings. These situations often offer the potential for above-average returns if the investor is able to assess the inherent value of the situation correctly. 3. Active management and research. Unlike the defensive investor, the enterprising investor is more actively involved in portfolio management. This includes conducting in-depth research into individual companies, industries, and market trends to identify profitable opportunities. Active management also involves monitoring and adjusting the portfolio based on changing market conditions. 4. Concentrated bets on high-quality stocks. While diversification is important, Graham suggests that the enterprising investor may benefit from concentrating their investments in a few high-quality stocks with strong potential. This allows for greater returns, but requires careful analysis and risk management. Timeless strategies and universal lessons to elevate your investing game. The positive side for the enterprising investor focuses on actively seeking undervalued stocks, special situations, and high-quality opportunities that can generate superior returns. Through diligent research, active management, and a focus on value, the enterprising investor can outperform the market over the long term, while still minimizing unnecessary risk. Chapter 8. The Investor and Market Fluctuations. In Chapter 8 of The Intelligent Investor, Benjamin Graham delves into the concept of market fluctuations and their impact on investors. He emphasizes that understanding and managing market volatility is essential for long-term investment success. Rather than reacting emotionally to market movements, Graham advocates for a disciplined, rational approach to handling fluctuations. Market fluctuations, natural and inevitable. Graham starts by acknowledging that market fluctuations are an inherent part of the stock market. Prices of stocks can swing up and down due to factors like economic data, corporate earnings, geopolitical events, and investor sentiment. These movements often have little to do with the underlying value of a company and are more reflective of short-term emotions such as fear and greed. The role of Mr. Market. Graham introduces the concept of Mr. Market, a metaphor for the stock market's behavior. Mr. Market is a hypothetical business partner who offers to buy or sell shares every day at fluctuating prices. Sometimes he is overly optimistic, inflating prices; other times, he is excessively pessimistic, offering shares at bargain prices. The key point Graham makes is that Mr. Market's mood should not influence your investment decisions. Instead, the investor should focus on the true value of a company, not on the daily fluctuations in price. The intelligent investor's response to fluctuations, rather than viewing market fluctuations as threats, Graham encourages investors to see them as opportunities. For example, during market downturns when stocks are undervalued, the investor can buy quality stocks at discounted prices. On the other hand, during market booms when stocks are overvalued, the investor should be cautious and perhaps sell or reduce exposure to overinflated stocks. The margin of safety. One of the key ways to handle market fluctuations is by maintaining a margin of safety. This means buying stocks at a price significantly lower than their intrinsic value, providing a cushion against market volatility. By doing so, even if the market experiences fluctuations, the investor is less likely to suffer significant losses. The long-term perspective. Graham stresses the importance of maintaining a long-term perspective when it comes to market fluctuations. While short-term market movements can be unpredictable, the value of investments will become more apparent over time. The intelligent investor should be patient, resist emotional reactions to market noise, and focus on the long-term potential of their investments. Must know tactics and wisdom to build a smarter portfolio. Market fluctuations are normal. The stock market will naturally experience ups and downs. Don't follow Mr. Market's moods. Investors should not be swayed by the emotional swings of the market. Use volatility as an opportunity. Market dips provide opportunities to buy undervalued stocks, while market highs can be a chance to reduce exposure to overpriced assets. Focus on intrinsic value. Base investment decisions on the long-term value of stocks, not on short-term price movements. In summary, Chapter 8 emphasizes the need for investors to remain calm and rational in the face of market fluctuations. By understanding market behavior, focusing on intrinsic value, and maintaining a long-term outlook, investors can weather volatility and achieve consistent returns over time. Chapter 9, Investing in Investment Funds. In Chapter 9 of The Intelligent Investor, Benjamin Graham discusses the role of investment funds in an investor's portfolio. He examines the benefits and drawbacks of investing in mutual funds, closed-end funds, and other pooled investment vehicles, providing insight into how these funds can fit into a well-balanced investment strategy. The role of investment funds. Graham acknowledges that investment funds provide an easy way for investors to diversify their portfolios without needing to pick individual stocks. Funds allow investors to pool their money with others to invest in a broad range of securities, which can reduce risk by spreading investments across different sectors and asset classes. Mutual funds and their limitations. Graham critiques mutual funds for being less efficient than many investors believe. While mutual funds provide diversification and professional management, they also come with drawbacks: high fees. Many funds charge management fees, which can eat into returns over time. Managerial discretion. The success of a fund depends heavily on the fund manager's skill, and not all managers can consistently outperform the market. Market timing. Many mutual funds attempt to time the market, which can lead to poor decisions and unnecessary risk. Closed-end funds. Graham also touches on closed-end funds, which trade like stocks on the exchange. While they offer the potential for greater returns, they can also trade at a premium or discount to their net asset value, NAV, which can lead to additional risks for investors. Index funds. A favorable option. Graham suggests that index funds are one of the most sensible options for the average investor. These funds track a market index, e.g., the S&P 500, and offer broad diversification at a low cost. Since they are passively managed, index funds have lower fees compared to actively managed funds. Essential insights and actionable approaches for investors of all levels. Investment funds offer diversification but come with potential downsides such as high fees and dependence on fund managers. Index funds are a cost-effective and simple alternative that track broad market indices. Investors should be cautious when selecting funds and be aware of their fees and risks. In summary, Graham suggests that while investment funds, particularly index funds, can be a useful tool for diversification, investors should be mindful of costs, the fund strategy, and the potential for underperformance compared to the broader market. Chapter 10, The Investor and His Advisors. In Chapter 10 of The Intelligent Investor, Benjamin Graham discusses the role of investment advisors and how investors should approach working with them. He emphasizes that investors must exercise caution when choosing advisors and should remain vigilant about their own financial decisions, rather than relying solely on external advice. The importance of due diligence. Graham stresses that while investment advisors can be helpful, investors must not blindly follow their advice. It's important to conduct independent research and fully understand the advice being given. Investors should prioritize advisors who are trustworthy and act in their clients' best interests, rather than those who may have conflicts of interest or hidden fees. Advisors versus investors. Graham points out that, ultimately, the responsibility for managing investments lies with the investor. Even if an investor works with an advisor, they should maintain oversight of their portfolio and ensure that the advice aligns with their long-term investment goals. Takeaway: behavioral finance insights and portfolio optimization essentials. Choose advisors carefully, seek trustworthy, well-informed professionals who act in your best interest. Stay involved. Even with an advisor, investors should retain responsibility for their investment decisions. In summary, Graham encourages investors to be discerning when working with advisors and to remain actively engaged in managing their investments. Chapter 11, Security Analysis for the Lay Investor, General Approach. In Chapter 11 of The Intelligent Investor, Benjamin Graham outlines a general approach to security analysis for the lay investor, emphasizing that thorough research and careful evaluation are essential for making informed investment decisions. The importance of security analysis. Graham explains that security analysis involves evaluating a company's financial health, profitability, and growth potential. For lay investors, this doesn't mean performing complex calculations but focusing on key indicators that reveal a company's true value. These include financial statements, earnings stability, dividends, and overall debt levels. Key principles for lay investors: focus on fundamentals. Investors should assess a company's intrinsic value based on its financial health and market position, rather than speculating on stock price movements. Avoid overcomplicating. Lay investors should stick to basic financial metrics like earnings per share, EPS, and price-to-earnings, P/E, ratio when analyzing stocks. Wealth building blueprint. Evidence-based techniques for market success. Security analysis doesn't require advanced expertise but should involve basic checks on a company's financial stability and potential for growth. Focus on long-term value, not short-term price fluctuations. In summary, Graham encourages lay investors to apply fundamental analysis to make informed decisions, focusing on a company's financial stability and growth potential rather than trying to time the market. Chapter 12, Things to Consider about Per-Share Earnings. In Chapter 12 of The Intelligent Investor, Benjamin Graham discusses the importance of per-share earnings, EPS, as a key indicator in evaluating a company's financial performance. However, he also warns that EPS should not be viewed in isolation or relied upon solely to make investment decisions. Key points about per-share earnings, limitations of EPS. Graham points out that EPS can be misleading, especially if earnings are manipulated or influenced by accounting practices. Investors should look beyond just the EPS number and consider other factors like consistency, sustainability, and the quality of earnings. Earnings growth. While growing earnings per share can be a positive sign, it's important to evaluate whether the growth is sustainable over the long term and not just a short-term spike. Key takeaways. EPS is an important metric but should be analyzed in context. Focus on consistent, sustainable earnings growth rather than one-time increases. In summary, Graham advises investors to look at per-share earnings as part of a broader analysis, considering the sustainability and quality of earnings rather than just the number itself. Chapter 13, A Comparison of 4 Listed Companies. In Chapter 13 of The Intelligent Investor, Benjamin Graham compares 4 different listed companies to demonstrate how investors can evaluate them using fundamental analysis. The comparison highlights the differences in financial strength, earnings stability, and valuation, showing how these factors impact investment decisions. Key takeaways. Diversification in analysis. By comparing multiple companies, Graham shows that an investor should look beyond individual performance and focus on overall financial health. Fundamentals matter. He emphasizes that the strongest companies, with consistent earnings and solid balance sheets, are more reliable long-term investments. Valuation. Graham points out the importance of buying companies at reasonable prices, not just based on their growth prospects. In summary, Graham uses the comparison to highlight the need for thorough analysis of company fundamentals, stability, and price before making investment decisions. Chapter 14, Stock Selection for the Defensive Investor. In Chapter 14 of The Intelligent Investor, Benjamin Graham outlines how the defensive investor should select stocks for their portfolio. The defensive investor prioritizes safety and stability, aiming for consistent returns with minimal risk. Key criteria for stock selection. 1. Large, stable companies. Graham advises focusing on large-cap companies with a proven track record of profitability and stability. These companies are less volatile and more likely to weather economic downturns. 2. Financial strength. companies should have strong balance sheets, with low levels of debt and consistent earnings. A solid financial foundation is essential for weathering market fluctuations. 3. Dividend history. The defensive investor should favor companies with a reliable history of dividend payments, as they provide steady income and demonstrate financial stability. 4. Reasonable price. Stocks should be bought at a reasonable price relative to their earnings and book value, ensuring a margin of safety against market fluctuations. Important insights from this chapter focus on large, financially stable companies with a history of consistent earnings and dividends. Pay attention to valuation to avoid overpaying for stocks, ensuring a margin of safety. In summary, Graham advises the defensive investor to select stocks based on financial stability, strong dividends, and reasonable valuation, ensuring a balanced and low-risk portfolio. Chapter 15, Stock Selection for the Enterprising Investor. In Chapter 15 of The Intelligent Investor, Benjamin Graham provides guidance on how the enterprising investor should select stocks. Unlike the defensive investor, the enterprising investor is willing to put in more time and effort to find opportunities for superior returns, taking on more risk in the process. Key strategies for stock selection. 1. Undervalued stocks. The enterprising investor should seek stocks that are undervalued relative to their intrinsic value. This could include companies with temporarily depressed stock prices but strong fundamentals. 2. Small and medium-sized companies. Graham suggests considering small-cap or mid-cap stocks, as they often present more growth potential than large-cap stocks. However, these stocks may also come with higher volatility and risk. 3. Special situations. Look for special situations such as mergers, spin-offs, or other corporate actions that may create value for shareholders. These situations can provide opportunities for outsized returns if the investor can assess their true potential. 4. Sound financials. Even with more aggressive opportunities, the enterprising investor should still ensure that companies have strong financials, such as consistent earnings and low debt levels, to protect against downside risks. Key lessons from this chapter. The enterprising investor should actively seek undervalued or small-cap stocks and consider special situations to generate higher returns. While taking on more risk, maintaining a focus on strong financials remains important. In summary, Graham advises the enterprising investor to be proactive in finding undervalued stocks or special opportunities that offer the potential for greater returns, while still ensuring a strong financial foundation to manage risks. Chapter 16, Convertible Issues and Warrants. In Chapter 16 of The Intelligent Investor, Benjamin Graham discusses convertible securities, convertible bonds and preferred stocks, and warrants, which are financial instruments that give investors the option to convert into common stock. Key points. 1. Convertible issues. These are bonds or preferred stocks that can be converted into a predetermined number of common shares. They offer the security of fixed income but also provide upside potential if the company's stock performs well. Graham suggests they can be a good option for cautious investors looking for moderate risk and potential growth. 2. Warrants. A warrant gives the holder the right to buy stock at a specific price within a set period. Warrants are typically attached to other securities, such as bonds, to make them more attractive. Graham cautions that warrants can be speculative and often do not provide the same safety as more traditional investments. Highlights from this chapter. Convertibles offer a balance of safety and growth potential, suitable for conservative investors. Warrants are more speculative and should be approached with caution, as they can lead to significant losses if the stock price does not rise as expected. In summary, Graham advises that while convertible securities can be useful for risk-averse investors, warrants are more speculative and should be used cautiously in a well-diversified portfolio. Chapter 17, for extremely instructive case histories. In Chapter 17 of The Intelligent Investor, Benjamin Graham examines for real-world case histories of companies that demonstrate different investment outcomes. These examples help illustrate important lessons on the risks and rewards of investing in stocks. Key takeaways from the case histories. 1. Investment versus speculation. Graham uses these case studies to highlight the difference between investing, buying for value and long-term growth, and speculation, buying based on short-term price movements or market trends. 2. The importance of research. The case histories emphasize that thorough research is crucial for making informed investment decisions. Investors should evaluate a company's fundamentals, such as earning stability and debt levels, rather than relying on speculation. 3. Margin of safety. These examples show that purchasing stocks at reasonable prices, well below their intrinsic value, provides a margin of safety, protecting investors from significant losses in case the market fluctuates or a company's performance falls short. 4. Long-term perspective. In all the cases, the companies that were carefully selected based on value and financial stability outperformed speculative or overpriced stocks, reinforcing the importance of a long-term investment approach. Key takeaways. The chapter emphasizes that successful investing is based on careful analysis, long-term value, and avoiding speculative behavior. Thorough research and a margin of safety are essential to protect against market uncertainties. In summary, these case histories serve as a powerful reminder that patient, well-researched investing based on fundamentals leads to more consistent, long-term returns compared to speculative, short-term strategies. Chapter 18, a comparison of 8 pairs of companies. In Chapter 18 of The Intelligent Investor, Benjamin Graham compares 8 pairs of companies to illustrate how different investment choices, even within the same industry or sector, can lead to vastly different outcomes based on factors like financial health, market price, and management decisions. Key insights from the comparison. 1. Valuation matters. The companies in each pair have different stock prices and financial health, demonstrating how valuation plays a crucial role in investment success. Even within the same industry, one company may be undervalued and another overvalued, leading to different investment results. 2. Quality versus speculation. Some companies may appear attractive due to high growth potential, but when overvalued, they carry significant risk. Graham emphasizes that the quality of the company, supported by strong fundamentals, is more important than speculative growth. 3. Financial strength. Companies with strong balance sheets and a history of stable earnings are more likely to weather market fluctuations and generate long-term returns. Conversely, companies with excessive debt or inconsistent earnings are riskier investments. 4. Market trends and investor sentiment. The comparison also highlights how market sentiment and short-term trends can lead to mispricing of stocks, causing investors to make poor choices if they are driven by emotions or hype rather than fundamentals. Core ideas from this chapter. The financial strength and valuation of companies are more important than simply chasing growth or market trends. Investors should focus on long-term value, stability, and reasonable pricing, rather than speculative or overly optimistic investments. In summary, the comparison of these 8 pairs of companies demonstrates the importance of careful analysis, valuation, and financial health when making investment decisions. Graham stresses that understanding the fundamentals and avoiding speculation leads to better long-term investment outcomes. Chapter 19, Shareholders and Management's Dividend Policy. In Chapter 19 of The Intelligent Investor, Benjamin Graham explores the relationship between shareholders and management, specifically focusing on dividend policy. Graham discusses how a company's approach to paying dividends can reflect its financial health, priorities, and the interests of shareholders. Key points on dividend policy. 1. The importance of dividends. Graham emphasizes that dividends are an essential indicator of a company's financial stability and its ability to generate consistent cash flow. For defensive investors, steady dividend payments can provide a reliable income stream and act as a sign of a company's financial strength. 2. Dividend versus retained earnings. Companies must decide whether to distribute profits to shareholders as dividends or retain them for reinvestment in the business. Graham argues that shareholders should be mindful of this decision, as management's choice can indicate their confidence in future growth. However, excessive retention of earnings without a clear plan for reinvestment can be a red flag. 3. Dividend policy and market valuation. A company's dividend policy can affect its stock price. Companies with a history of stable dividends are often valued higher, as investors see them as more reliable. On the other hand, companies that reduce or eliminate dividends may face negative market reactions, even if they are reinvesting profits for growth. 4. The investor's role. Graham advises that investors pay attention to dividend history and consistency rather than focusing solely on high dividend yields. A high yield can sometimes be a sign of financial distress or an unsustainable payout ratio. Summary of key points in this chapter. Steady, consistent dividends are a sign of a healthy, stable company. Investors should assess whether retained earnings are being used wisely for future growth or if dividends are being withheld unnecessarily. Focus on sustainable dividend policies rather than short-term market reactions to dividend changes. In summary, Graham emphasizes that dividend policy reflects a company's overall financial health and its commitment to shareholder value. Investors should carefully evaluate a company's dividend strategy, ensuring it aligns with long-term growth and profitability. Chapter 20, Margin of Safety as the Central Concept of Investment. In Chapter 20 of The Intelligent Investor, Benjamin Graham introduces the concept of the margin of safety, which he considers the most important principle of investing. This concept is about ensuring that the price paid for an investment is sufficiently below its intrinsic value, offering a cushion against errors in judgment or unexpected market fluctuations. Key points on margin of safety. 1. Definition. The margin of safety refers to the difference between a stock's intrinsic value and its market price. By buying securities at a price lower than their intrinsic value, investors reduce the risk of permanent loss of capital. 2. Risk reduction. Graham emphasizes that the margin of safety is a key element in protecting investors from downside risk. Even if an investor makes an error in assessing a company's value, the margin of safety helps to cushion against significant losses. 3. How to apply the margin of safety. To calculate the margin of safety, investors need to carefully assess a company's intrinsic value, considering factors like earnings, assets, and growth potential. If the stock is priced much lower than its intrinsic value, it presents a good opportunity with a built-in safety buffer. 4. Conservative investing. Graham argues that the margin of safety should be the foundation of every investment decision. It encourages conservative investing, where decisions are made with caution, and only undervalued stocks with strong fundamentals are purchased. 5. Avoiding speculation. The margin of safety also helps differentiate investing from speculation. While speculators chase stocks based on price trends and short-term predictions, investors focused on margin of safety make decisions based on intrinsic value, with an emphasis on long-term financial stability. Crucial lessons from this chapter. The margin of safety is the gap between a stock's market price and its intrinsic value, providing protection against downside risk. It encourages conservative, value-based investing, where the focus is on purchasing undervalued stocks with strong fundamentals. This concept is essential for reducing risk and ensuring long-term investment success. In summary, Graham's concept of the margin of safety is the cornerstone of prudent investing. By focusing on buying undervalued stocks with a substantial margin of safety, investors can protect their capital and reduce the risk of significant losses, ensuring more stable long-term returns. In The Intelligent Investor, Benjamin Graham lays out a timeless and systematic approach to investing that focuses on risk management, value investing, and long-term strategies. He introduces key concepts like the margin of safety, investing versus speculation, and the importance of financial fundamentals, all of which are essential for making sound, informed investment decisions. For defensive investors, Graham stresses the importance of a balanced, diversified portfolio, focusing on large, stable companies with consistent earnings and dividends. The enterprising investor, on the other hand, is encouraged to take a more active approach, seeking out undervalued stocks or special situations that offer higher potential returns, but with a clear focus on maintaining a margin of safety to mitigate risks. Graham also emphasizes the significance of patience and discipline, advocating for an approach that resists the temptation of market speculation or chasing trends. Instead, investors should focus on intrinsic value and long-term growth, and avoid being swayed by the short-term noise of the market. Ultimately, Graham's principles encourage investors to make decisions based on rationality, caution, and careful analysis, rather than emotion or speculation. By adhering to these principles, investors can achieve steady, reliable returns and build wealth over time while minimizing the risk of substantial losses. The core of Graham's philosophy remains a powerful tool for anyone looking to navigate the complexities of the financial markets successfully.